Hello everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 12. This lecture is in continuation with lecture number 11. Here we will continue to discuss the Ind AS 115 provisions. Okay. Now as you know that there is a 5-step model for recognizing revenue from contracts with customer. Okay. There is a first step which says identifying contracts with customer. There is add-on provision to it which says multiple contracts can be combined when, let's see, there are some conditions attached to it. So, okay, let's see, an entity shall combine two or more contracts into, at or near the same time customer and account for as a single contract. Okay, there is an option given that multiple contracts can be accumulated and can be aggregated and can be recorded as one particular single contract when only and only when at least one of the conditions are satisfied. Okay, and what are those conditions? First condition is that the contract is negotiated as a package. Okay, whenever the agreement is being done between the parties, okay, they are agreeing to the contract as a whole package. First. Second, the amount of consideration to be paid in the contract depends on the price or performance of other contracts. The multiple contracts are dependent on each other. One's payment is dependent on completion of other contracts. Okay, there is dependency, there is no independence. Okay, so you can say it is negotiated as a package, first thing. Secondly, there is dependency. Third, the goods and or services promised in the contract as single performance obligation. These amount to as single performance obligation. This means that the multiple contracts also, if we combine that, there is one final single performance obligation, that is one particular asset or you can say goods or service has to be transferred. There is only one whole sole responsibility when we accumulate or when we aggregate these particular contracts. Then only combining contracts is allowed. Then only particular more than one contracts can be shown as single contract. Okay. Next, identifying contract modification. Okay, what is modification? Whether you are changing any scope, nature, okay, timing, amount. If anything of either of the terms are changed of the previous existing initial contract, then this is known as modification. As you know, the modification should be accepted, should be approved, then only it will be considered. Okay. Firstly, modification exists only and only if, for example, partial terminating, extending or reducing the contract. The time of contract has been changed. Either it has been decreased or increased. Either it has got extension or has got termination. Okay, either of it. The timing of the contract has changed. A contract modification exists if 3 conditions are met. There are another 3 conditions that justify that amount to the modification of a contract. What are those? First, there is a change in the scope, price or both in a contract. Either there is change in scope. Okay, for example, there is a building construction of a building contract. Okay, for example, now as you are a construction company, you will be having a revenue from such construction contract. Okay, that's fine. Now there might be that you have given the contract of constructing 3 floors. Now you are widening the scope, adding some other things that like that please, instead of making 3 floors, make 4 floors. You are extending or increasing the scope, changing the scope, or you say there is a change in price. Okay, that will be paid, either decreased or increased. Then this will be known as modification. Second condition, that change is approved by both the entity. It should be approved. It should not be like the people who are not having authority and are changing the scope or nature or price of the contract. Okay, it should be via proper authority and it should get approval with both the parties. Okay. Third, the change is enforceable. The change will come into effect. It is enforceable by the parties. Then only it will be considered as contract modification. The approval of a contract modification may be either written or oral or implied by customary business practices. Either it is in the written form, either it can be oral, or other than that, there is past business practice that if this particular event happens, it will be doing this particular change in the contract. Okay, for example, there is any inflation clause. When you, for example, okay, this is a far away example, but if for example, if you are taking a loan and the interest rate is always with an asterisk sign, that means terms and conditions applied, the bank has power to add inflation clause. Okay, there is always an inflation clause in the contract, and they can revise the rates and the amounts. Okay, so this is known as customary business practices. Okay, any amount, any right that a particular business is having due to its past services, its past practices, and it is implied, it is not negotiated at the time of agreement, but it is implied that if such particular event happens, the particular entity has whole right or has more of a chances that they will be changing the scope or price. Okay, so it should be, the approval should be written or oral, it should be by the both parties, and lastly it might be due to the implied conditions of the business practices, of the past customary business practices. Okay, next, what is distinct goods or services mean? This is very important. Anybody who is learning Ind AS, okay, either a professional or a student, but you really need to learn this definition, you really need to have a very good knowledge about this definition. Okay, because this comes again and again repeatedly, and on the basis of this further it is classified that is there are number of performance obligation. You identify on the basis of distinct goods and services are present or not, standalone price is there or not. Okay, we will deal into that in a later part, but here it is important to understand firstly this distinct goods and services. What is it? When it is said to be that a particular service or a good, a particular performance obligation is distinct good or service. When first, a good or service that is promised to a customer is distinct if both of the following conditions are satisfied. This means condition 1 plus 2, if both are satisfied, then only it will be considered as distinct goods and services. Okay, first, the customer can benefit from the goods or service either on its own or together with the available resources. That means the goods or services that are being transferred, the goods and services transfer of which has been promised, can be used, they have a capacity, they have a capability that they can be used on their own, or they can be used by using the available resources. They do not need extra setup, they do not need extra buying, selling and setup of any other particular goods, service or asset. Okay, they are fair enough, they are independent enough to be used on their own, or you can say to be used together with the available resources that are held with the entity itself beforehand. Okay, second condition is there. The entity's promise to transfer the goods and services to the customer is separately identifiable from other promises in the contract. That is, the goods or services are distinct in the context of the that particular contract. If they are separately identifiable, they are distinct in the context of that particular contract. Okay, these are two conditions. If you take a perspective of overall thing, then you have to apply condition 1. If you are just seeing from the perspective of a particular contract, then you have to see, is it separately identifiable? If it's yes, then only it will be considered that there are distinct goods and services. Okay, it is distinct goods and services. It has a very major role. If you are a student and preparing for any exam, please learn this definition. Okay, even being a professional, if you learn this, it will help you a lot. I guarantee this. Next comes is contract modification, as we have heard right now. Okay, modification, the combination of contract, it should be approved. Okay, as you know, let's see, is modification approved? This is summarized for your convenience. Okay, this is simply summarized. Is modification approved? If yes, then go ahead. If no, it is not approved, then you will ignore it and not at all record in the books of accounts. Okay. Now, if it is approved, then you have to secondly check that are remaining goods and services distinct. Why I have told you about the distinct goods and services? Because it will be used again and again. Okay, like here you have to next check that whether the goods and services for which the contract is being done with the customer is distinct or not, is different or not, distinct or not. Can it be used in its own capacity, or in the context of the contract, can it be separately identifiable? If yes, then these are distinct goods and services. So if modification is approved, secondly, if the goods are distinct or the services are distinct, then you have to see, yes, you will account for the modification. Yes, you will account for the modification. Now see how it will be done. Price change represents, if the price has been changed, scope or price can be changed and it will be considered as a modification. If price has been changed, you have to see that, you have to check again that is the price that has been changed, the price that are being charged, renewed prices, is the transaction price reflect entity's standalone price? Again, to quickly revise, what is standalone price? Any price that you would have charged from any passing customer without any influence, without any biasness. If such price rise or price decline, anything, if such price change represents or is very much equal to the standalone price that you would have charged from any other customer. Okay, if it is yes, then you will record such particular modification as a separate contract. If no, such goods are not distinct, or you say that the transaction price is not standalone, it is influenced, okay, then you will be recording it, the modification as prospectively. Okay, prospectively, this means henceforth from the coming date. Next, example is given to clarify the above thing. A Limited enters into a contract to B Limited for construction of building up to 4 floors. Okay, there is a contract of building 4 floors. All right, at an agreed consideration of rupees 200 crore. It's okay. After construction of 3rd floor, okay, the contract was a 4th floor. After the end of the completion of the 3rd floor, still 1 floor is remaining to be constructed. Okay, in between of the contract, after end of the 3rd floor, A Limited further change the scope of the work to construct up to 6th floor. Scope, if scope is changed or price is changed, it is termed as modification. It is considered as modification. Additional price depends upon normal commercial terms. Evaluate whether contract is approved or not. Okay, so you have to see that whether the further change that has been done, the scope has been changed, is it modification or not? Yes, it is modification. Okay, increasing scope amounts to modification. Normal commercial terms, contract is approved. Why so? Because this is normal commercial terms over here means standalone price. It is equal to the standalone price. If it is yes, then you will consider it as approved. Why approved? Because there are no biasness or influence over here included. Okay. Now, should it be recorded as separate contract? Should it be recorded as separate contract? Then for this, information is right now not complete, because you need to see that whether it is negotiated as a package, whether the price difference, the price change is standalone price. Okay, if yes, then modification will be treated as another contract, separate contract. If not, then same contract. Next, example 2, very important. This is ICA example, ICA question. Okay. A Limited entered into a contract to complete infrastructure work for 200 hours at the rate rupees 150 per hour. Okay, 200 hours contract is there, at the rate 150 per hour will be paid. After working for 100 hours, this means only 100 out of 200, only half hours have been spent, still 100 hours are remaining. A Limited and customer agreed to change scope of the work and estimated labor hour increases to 50. Okay, increases 50 hours at the rate rupees 100 evaluate. Now firstly, initially the contract was of 200 hours. Now the scope has been increased. Now the new hours are 250 hours, out of which 100 have already been completed, already been accounted, already been recorded in the books of accounts. Okay, so for first 100 hours which have already been completed before such modification came into picture, this means the first 100 hours that have been completed will be recorded at the previous rate, because there was not at all any changes, not expected changes. So the previous rate will be applied for first 100 hours. Okay, what about the remaining hours? They will be charged with a new rate, that is average rate. Okay, let's see. Initial contract was of 200 hours. Now the new scope has been increased and the hours have been reached to 50 hours additional. This means 250 hours. Okay, this is 150 at 150, and the another 50 hours are for rupees 100. Okay, it is given in the question. It is all given in the question. So this is now amounts to 35,000. Great. Now 35,000 divided by 250, you will get an average of 140. So initially the first 100 hours that have already been recorded will be recorded at 150, the previous rate. The henceforth hours after completion of the 100, after modification, will be recorded at the modified average rate. Okay, that is 140. Let me know in case of doubt. Okay, please let me know. Example number 3. These examples are very important to get an insight of the concept. A Limited agreed to provide services for rupees 3 lakh up to 3 years to B Limited. At beginning of third year, contract is extended to 6 years. Initially it was 3 years and 3 lakh rupees was there. So every year they were charging to P&L was rupees 1 lakh. Okay, fine. At the beginning of third year, this means 2 years have been completed. 2 years have been completed and have been charged as per the previous rate. This means 1 lakh and 1 lakh for year 1 and year 2 have already been charged. Now comes the third year beginning. The contract has been extended for 6 years at additional price of rupees 2 lakh. Now the contract, instead of 3 years, it is now of 6 years. Okay, 2 years have been completed, remaining years are now 4 years, and the amount 1 lakh has yet not been charged. Out of this, 2 lakh have already been charged. 2 lakh already charged. Okay, and what about 1 lakh remaining? And in addition to this 1 lakh, still this 2 lakh is additional price. Okay, so 1 lakh plus 2 lakh, this is 3 lakh. This is 3 lakh and divided by 4 years. Why 4 years? 6 minus 2 years. Why 6 years? Total contract now is of 6 years and 2 years have already been completed. So this 3 lakh will be divided in upcoming 4 years. So for year 1, it was 1 lakh, no doubt. For year 2, it was 1 lakh. Great. From year 3, 4, 5, 6, it will be 75,000. How come? 1 lakh that was remaining of the previous amount, and then 2 lakh additional that have been increased in the price. 3 lakh divided by 4, that is 75,000 per annum. Okay. Next, modification that constitute separate contracts, according to which the contract should be recorded separately. When? First, an entity accounts for a contract modification as separate contract if there is modification of both increase in the scope of work promised under the original contract by adding new promised goods and services that are considered distinct. The scope has been increased and the goods and services are distinct. Scope increase. If scope increased and the goods and services are distinct goods and services, goods and service. Okay. If this is the case, then separate accounting will be done, separate contract will be recorded, the modification. Okay. Any modification that has been done will be recorded as a separate contract, Condition 2, the increase in the contract price reflects the standalone selling price. Okay, it should reflect the standalone selling price. If yes, then such modification will be recorded as separate contract. This is a summary. You have read this in the summary as well. See, if you remember, account contract modification, you have to see that there is change in scope and the price change is equal to the standalone selling price. If yes, then a contract modification will be recorded as separate contract. Okay. Next, example number 4. Let's see what is it. A Limited entered into contract for customer to sell 500 unit at the rate rupees 100 of a product A in next 12 months. Okay, they have to sell 500 units at the rate rupees 100. After delivery of 400 units, A Limited further enter into contract with customer to deliver 300 unit of product A. Okay, after delivering 400, there is additional 300. Okay, product A for rupees 90. Now the question itself says that rupees 90 represent the standalone price. So there is an increase in the scope, there has been change in price, and the price reflects standalone price. Therefore, it should be recorded as separate contract. So answer is account both contracts as separately. Modification that constitutes separate contract. This is an example of the same. Lastly, let's summarize all this lecture, full lecture. Okay, what we have read till now, that if there is when there is separate accounting needed, when there are distinct goods and services, plus there is price increase which represent standalone price, and when can the contracts be combined? Firstly, there is cumulative catch-up adjustment. If there is cumulative adjustment, that means distinct goods and services plus transaction price relates to original contract itself. Okay, the price is similar and very much related to the previous price. There it is not related to standalone price. This is catch-up price, that is only the adjustment for the same on the basis of the previous price. Okay, there is no standalone price. Then this will be recorded as a combined contract because it has similar characteristics. No difference in the scope, no difference in the price. Okay. Secondly, prospective accounting is needed. In combined, prospective is needed when the goods and services are not distinct. Okay, here they are not distinct as well as they are related to the original price. Not distinct as well as related to the original contract price. Here they are not distinct. Part of obligation is satisfied, part is unsatisfied, and the price is not yet standalone. Okay, here we will be recording the prospective accounting henceforth. Okay, that's all for this lecture. We'll continue in lecture number 13. Please stay tuned and watch all the lectures. For full videos and full course, for PDF notes, definitely check out the description box. This is Swati Gupta, Chartered Accountant. See you in the courses. Till then, take care, be safe, stay tuned.